Welcome to another edition of the Sentinel video series. This time we're going to talk about the little known, little experienced world of deflation. What is deflation? Deflation can best be expressed as a reduction in the amount of outstanding credit. People tend to experience inflation as rising prices, but that really is only the effect of inflation. Likewise, people perceive deflation as a fall in prices, but that also is only the effect of deflation. In another one of our video series on the wonderful world of credit, we talked about how credit was equal to confidence. Without confidence, there was no credit. Likewise, we can postulate economic law number 2, which says that deflation is a lack of confidence. So if there is a reduction in the amount of credit, that means there is a reduction in the amount of confidence. If deflation is a lack of confidence, what caused the deflation in the first place? Well, one way could be that a borrower acquired too much debt and can then not service the payments. Likewise, a lender may have suffered losses in some of their investment activities. And common in both cases, the aftermath is a psychological change in borrowers and lenders, which means that borrowers then do not have the same propensity to borrow as before, and lenders likewise do not have the same propensity to want a loan. Let's look at some examples of some potential deflationary events. One could be on the credit card side. We could see smaller credit lines and higher interest rates associated with credit cards. Another example might be banks tightening their lending standards and perhaps increasing their interest rates associated with those loans, and thus reducing the amount of home loans available to borrowers. A deflation example can even hit the stock market by the regulation of the amount of margin trading that can be conducted by traders, or the percent associated with the margin trading. Commercial banks could also reduce the amount of money that they loan to businesses. Another little known deflationary example would be the increase of bartering or barter networks. Through bartering, people exchange goods and services without a medium of exchange, as described in another one of our videos. The result of that is that there's less of a demand for credit, which of course is a deflationary event. Another thing that occurs is communities or organizations issue scrip, which are representations of some medium of exchange, but it does not represent legal tender. There is no credit associated with it. The fact that there is no credit associated with the issuance of scrip means that that is also a deflationary event. Well, those are some examples of deflation, but what are some of the effects of that? In the credit card realm, if we have smaller credit lines or higher interest rates, then we would reduce the demand for items purchased on credit. And oftentimes we see stores trying to extend their own credit because of reduced credit lines available. Another one, of course, would be the reduced demand for housing with tighter credit standards associated with residential loans. For stocks, a reduction in the amount of margin trading allowed will potentially have the effect of reducing the demand for stocks. For commercial property borrowers, the fact that banks may restrict the amount of loans that are available for commercial real estate, that could also reduce the demand for commercial property. Probably one of the most subtle deflation effects is an increase in the demand for cash, whether that be currency, bills, or demand deposits. There is typically an inverse relationship in the demand for credit and the demand for cash. So if we have the supply of credit tightening or being reduced, then the amount of demand for cash should increase. In fact, it can be stated that during a deflation, cash is king. But just because there's an increased demand for cash during a deflationary environment does not necessarily mean that the cash materializes out of thin air. So in order to get more cash or demand deposits to pay debt, as an example, or perhaps just for everyday expenses, you might need to do what's on the right side of the screen, which is sell assets, whether those be homes, RVs, and most recently we've seen an upsurge in the amount of precious metal or jewelry sales that have been advertised to the public, mostly by virtue of higher gold prices, but there's another component as well, and that component deals with the fact that people need to liquidate some assets in order to raise cash. This is an example of a bank balance sheet that was used in another of our video series, but we want to focus a little bit more on the asset and equity and liability side where it relates to a loan to our friend Ben. Let's say our friend Ben defaults on his loan. In other words, he cannot pay it back. If we notice, then the bank has to write off that loan as an asset, also on the liability side, but more importantly, the overall supply of money or credit that's available in the system or in the economy is reduced by $5,000. Another effect of loan defaults are nervous depositors. If we look at this balance sheet and we see Timmy has a demand deposit for $5,000 in that bank, if Timmy starts to be concerned about the fate of his money and he decides to withdraw his $5,000 or perhaps even something above $1,000, we see that the bank only has $1,000 in cash available. And if there are enough depositors that feel this way, then we have what's called a bank run, which is an incredibly deflationary event. But it's not just a loan default that is deflationary. What about paying back a loan? Again, let's take a look at this loan to Ben where we have an asset on the banking side of $5,000 and a total money supply right now of $11,000. When the loan is paid, we wipe off $5,000 from the asset side of the bank. We did get paid our $500 worth of interest for the loan, as reflected in the $1,500 of cash, and we have additional equity available as well. But if you notice, the total amount of money in that economy, which was before $11,000, is now $6,500. What if instead of having a credit loan, we actually had a cash loan? What happens to the supply of money when a cash loan is paid? Well, the answer is nothing. When a borrower borrows a $1 bill and pays back a $1 bill, there is no cash destruction that takes place. In the example that we had earlier with the bank, when the loan is paid back, we literally wipe off that amount of loan from the bank's ledger, which means that the overall supply of money in the economy, or in this case credit, is reduced. In the cash example, that does not occur. So let's review what we've learned. We know that deflation is a reduction in the amount of outstanding credit. Since we're in a credit-based economy, anytime we reduce the amount of credit, that becomes deflation. An effect of deflation is falling prices. Deflation essentially then reflects a lack of confidence of borrowers and lenders. Borrowers have not the same propensity to borrow, and lenders, of course, do not have the same propensity to lend. The lack of confidence then becomes a psychological phenomenon. Another thing we learned was that in a deflation, cash is king. Reduced demand or availability for credit means cash is required for the payments of debts and general expenses. Less demand and availability of the credit means more demand for cash. And as we learned earlier, in order to raise that cash, sometimes we have to sell assets. Deflation typically follows inflationary periods, so we will not have a deflation until we have some inflation that precedes it. Most of the money in our economy is credit, so when we talk about things relating to money or money supply, in reality what we're really talking about is credit. Thank you for watching this video on the very little understood and often misunderstood concept of deflation. Brought to you by the Sentinel. You can reach us at www.thesentinel.biz. Our purpose is to educate readers on investment topics and economic trends. We know that there are oceans of information available out there, but how much do readers truly understand? Investment failure is often the result of misunderstood information and an inability to identify changes in trend. We know that because people typically invest on what other people are doing, and this type of crowd following can be very deadly during trend changes. Rather than simply telling you what to do, we try to explain the reason for taking specific action. The explanation is given with historical context and contemporary example. Such an approach applies reasoning to an investment action rather than the herding instinct that we typically see in the investment environment.